Hello and welcome to a brand new show of Market Makers, the show on which we'll debate, deliberate, ideate that where markets are headed. Will it be a long winter for India or will it be a long winter only for Europe and US? India is outperforming, but is the outperformance here to stay? And if the outperformance is real, where are markets likely to migrate? When we started the year, it was all about IT. Now it's all about banks and cyclicals. What is the real trade? Comeback of IT or long live the capital goods and the banking trade? Now to discuss all that and much more, I have with me a practitioner of technicals, a practitioner of market and human behavior, Atul Suri. Fantastic to have you back. Thank you for joining us. It's so nice to meet you again. Let's start with a high five. Always good to do that.
Always good to go.
When two boys and friends meet.
Yes, why
Let's
not?
start with high five.
Sure.
The bulls are also saying high five. Jackson Hole has come and gone. 6% is what S&P has fallen. Indian markets are flat. So we are outperforming relatively and on an absolute basis.
So, Nikunj, what has happened is that October 21 was the high for most global markets. Okay. And you'll notice that we have been actually correcting in a channel. So we have spent almost 11 months in a correction. We haven't seen that. And those 11 months have, the index may be whatever, 5%, 6%, but the pain in portfolios is a lot more because the growth space has suffered a lot more. Like the tech index is down 25%, even right now. So the pain is a lot more. We've had 11 months of correction and we've had price correction also, which is much more, as I said, than optically visible. So there is a lot of negative news. There's a lot of negative sentiment. In fact, yesterday I was reading a survey of fund managers that the next 10% move in S&P will be up and down or down. 70% felt that it would be down. So the mood is pretty negative. Yes, there are issues with the Fed, there is the narrative, and there is fear that in the short run there will be pressure on the market. But I have never seen markets fall off massively after 11 months of underperformance, of 11 months of correction, and after a good percentage fall. So the sentiment is bad. And I think that this is a great time for India to buy on dips market. Yes, we will correct along with global markets, but we will correct less. And I think this is a very good chance or very good opportunity for investors to deploy money because I feel that we are in the cusp of something very big. This is a phase where I almost get a 2004 deja vu. Simply the way the sectors are moving, simply the way the market is shaping up. And for me, I become very, very bullish for the market. If the corrections are there, people should use this as an opportunity to deploy money.
Then why buy for dip? If we are in a long haul bull market, like Rakesh Jhunjhunwala used to always say that ITC का भाव अगर 500 से 1000 होना है, तो it doesn't matter whether you bought at 600 or 700, as long as you know that the trajectory is over. The problem with buy on dip is that you don't know what is the right definition of dip.
Yeah, again, it's for people like me who are in the market, who look at market closely, but definitely for some people who are a little distant from it, I feel that the phase that comes, whether you do it in a systematic way or you do it at one shot, etc., the phase for buying is coming. The phase for buying on dips is coming. At what price you buy and what you buy is obviously a much different discussion area.
Where can Nifty go in this cycle?
See, I think that the first move, which we are sub 18, 17.5 or thereabouts, I think we could head to around 21,500.
In this year, do you see that happening?
I wouldn't give it a calendar month and things like that, but I feel the next leg up should take it to around 21,500. But I think this will be just the start.
Okay, so it's the party doesn't get over at 21,000.
No, I think the way the current technicals are shaped up, the next up move will take us to 21,500. But as I told you, that the way I am seeing the themes internally, I'm getting a 2004 deja vu moment. Let me explain.
Yeah.
If you look at the leadership sectors are not what have done well for a decade. In fact, they have been the more defensive places. Those are the sectors we went to when there was no massive industrial activity. Today, leadership is in autos. Autos is a very good secular theme, a proxy for industrial activity. Capital goods. You will find a lot of PSU banks. You see, these are sectors or themes which are very closely linked to the industrial cycle. And they have not done well for a decade. This is where under ownership. And here is where I'm seeing leadership. In fact, if you take the October high to now, all these sectors are actually, the indexes are positive. On the flip side, You have sectors which were defensive plays, which people ran to in time of difficulty, like pharma for that matter. You find it's what, 10, 11% off. IT, as I said, is 25% off. So the internals of the market, the composition of sectors is giving me a sense that as a country, we are likely to see a revival of industrial activity, which has been eluding us for almost a decade. And when such bull markets start, they tend to be very, very long. In fact, I dare say that we will outperform the US markets also.
Which is what we've done from Jackson Hole. If I look at a very myopic data point,
very short term, yes.
we are up
short.
6%. I mean,
In
we
a
are down 6%, which means we are up 6%.
Yeah. So let me put this in a longer term data. So we do something called a ratio chart. Okay. A ratio is nothing but the relationship of one index versus another. The runaway market for the last many years has been the US, and the S&P 500 is a good proxy for that. Europe is a basket case. Emerging markets are a basket case. The big driver is the US, and let's take SPX. So we do a ratio chart between SPX and Nifty 50. And we feel that we are coming out of a 10-year range.
So in Nifty is coming out of a 10-year range.
In relationship to SPX.
Okay.
So Nifty, in spite of doing very well, has relatively underperformed or has not outperformed the SPX. But what we see is that that relationship is working towards the favor of Nifty after 10 years. So this is linking to my earlier thesis that what India I see happening is a revival of the industrial cycle. Then irrespective of what global markets are, our relative outperformance will continue, and I think this time we will outperform the US markets. So we will emerge as one of the strongest, and I can give you a lot of points, a lot of observations.
No, it is evident looking at the fact that we are frankly not very far away from an all-time high on the Nifty.
We were what, 4% away?
Exactly.
From 18,600 till a few days ago.
So how much more do you think this bull market will accelerate before we talk about a euphoric or a market peak? Because you understand cycles, right? If this is beginning of a bull market, according to your analysis, then where do you think this bull market will extend itself? I'll be looking at numbers of 30,000, 35,000, even beyond 35,000 on the Nifty.
See, one would like to believe in those numbers, but what I feel, Nikunj, is what's going to matter is the delivery. In terms of numbers and economic activity. See, these are early phases. But as I said, that whenever I've seen these sectors emerge, they do not end in 1 quarter or 2 quarters. They really tend to be 2, 3, 4-year cycles. As I said, that is what we saw in 2003-04. It went on till 2008. And of course, excesses happened on the other side also. And economic world conditions were different. Those are, of course, a lot of variables. But if I look at it in a narrow stage, there is a cause for bullishness. I feel 21,500 could be the first stop. And if the commodities, and there are many other asset classes at play, if things fall in place, I feel that we could actually start an extended move. Makes me very, very optimistic. And that is why I feel that in this fall that is happening due to global tremors, it's a buy or dip opportunity.
One of my favorite questions, at least with Rakesh Jhunjhunwala, was that if the bull market is like a train journey, starting from Churchgate to Kandivali, where do you think in your analysis this bull market has reached?
I think we are at the first platform.
Okay, so we've not even reached Bandra.
No, we have not at all. In fact, we are still somewhere out there in the start phase. Because if you look at the market,
so this is the beginning of the bull market.
Absolutely. We look at the sentiment. Look at indexes.
What about you that bullish, my friend?
No, it's not about, as I said, I'm not speaking about 1 week. I'm not speaking about 1 day. I'm not speaking about 1 month. As I said, that when I'm talking about getting a deja vu feeling, and this is the internals of the market. It's the sectors. It is the breadth. The mid-cap index, if you look at it. Again, interestingly, the small caps are not doing too good. That kind of retail euphoria. Like, correct me, but, I think the mid-cap index is 4-5% from lifetime highs.
Till last week, the small cap index was down 20% from its peak.
Absolutely.
I've not looked at this fixed data.
Yeah. So, what we saw a few months or maybe 6-9 months ago was a very big outperformance of small caps. Small caps is a very big representative of retail activity where a lot of excesses happens. But this time you see the move is more into mid to large. And I think that is a very, very sweet spot. And that's where we find ourselves sectorially, thematically. That is what these internals make me positive. See, what's happening in the macro space and all is very, very wide. A lot can happen. But as things stand, as data shows me right now, makes me very, very positive.
I just want to use a few terminologies which Atul is trying to indicate. FOMO is the word which is used in the market. I guess in this market, FOMO is the right human behavior which has characterized the market rally from June to September. Now, you may use the nursery rhyme phrase and call it sour grapes. Some would say this bull market has managed to climb the wall of worry, but I would say FOMO is the real word which in a sense captures the market mood. Everybody is waiting for market to come down and market is not coming down. And folks, let me tell you, bull markets do not come down, and when they come down, it's going to be for reasons which you cannot comprehend. So Atul, we are spending some time on this 2004 comparison.
Right.
But between 2004 and 2008, the world also did very well.
Absolutely.
Right? Commodity prices did very well. Liquidity moved into a different zone. On all those parameters, we are staring at a different scenario. Commodity is coming down, liquidity is going to be contracting.
Correct. Yeah.
Globally also, there was a huge unleashing of liquidity which happened by central bankers.
Yeah.
A lot of those factors are not with us.
Absolutely.
So while it may smell like a 2004 bull market,
Right.
it does not feel like a 2004 bull market.
So what I feel is that this time it's not going to be, as I said, very, very global in nature.
Okay.
Like, when I talk about this ratio, the S&P or the US may do nothing for a couple of years, but it is India would relatively outperform. So yes, the size of move may not be there, but the relative outperformance, in my view, will be there. I feel, Nikunj, one very big thing that is going to happen, which will surprise the world, is the crack in commodity prices. Today, if you see inflation, which is the root cause of problems, why interest rates going up, why is liquidity being tightened, is because of very high inflation. And this inflation is massively led by commodities. I feel when I look at underlying commodity global prices, I feel there's a 30% correction likely to happen.
Would you go short on commodities then?
I would think so.
Across the board?
I would think so. And I feel that what's going to be very, very interesting for India is that if we see a crack in crude, like I look at Brent crude and I see that, none of these commodities demand is at record highs, or we have still reached pre-COVID levels, where what has happened is that there is a lot of speculation. If you look at crude, and I look at it very closely, you realize it's a function of politics. It's total geopolitics at play. And geopolitics is something that can change very, very fast. So I think that there is going to be a very big correction in commodities. And today, what is a central concern for us, inflation, 3-6 months down the line will not be the center point. In fact, the center point of talk is going to be growth. And that is why I feel that the Fed is not going to be as aggressive. And the Fed has been changing its commentary every few months. So this can also change very fast. Right now, they are extremely, extremely hawkish. But I think that they can get very neutral very, very soon. And if commodities crack, it's very positive for India, especially in the energy basket and for a lot of Indian companies. Because the raw material cost will come down. They have all taken price hikes. The top lines are there, the demand is there, but the margins are getting compressed. If your raw material cost comes off, I don't know how much they will take a cut in prices, but the profitability will shoot up. And I think that could be a very, very big trigger for India.
Again, an example for viewers, once samosa prices, they go higher, they never come down. And that is inflation at work for you. Prices, when they go up, they never come down, even though raw material prices have come down, provided companies are able to enjoy pricing power. Atul, the narrative this year has changed almost at 180 degrees.
Absolutely.
Right? The beginning of the year, everything was digital. Everything appeared that is going to be contracting and shrinking into a laptop screen in front of us. And the price action was suggesting that. Today we are saying goodbye IT. So the narrative of decline in commodity today could change differently in 3-6 months. So
my biggest learning in the last 2 years, Nikunj, post-COVID, is that the length of cycles has reduced. Like as a thing, we would look at 3 to 5 year cycles. You would like to hold for that. Look at 2000. The sector to have was pharma.
Yes.
Correct? It is down in the dumps.
The pharma is a painful sector to have. A sector which caused pain is giving pain now.
21 was all about IT. It's down. 22 has been about commodities and metals for that matter. I feel that this will be the next. So the cycles have become very, very sharp and very, very fast. And as fund managers, we face a lot of challenge because it will mean that you have to churn your portfolio hell of a lot. Because to create outperformance, you have to be with the trending space. But that is the new reality. You have to live with it. Ultimately, we are slaves of returns. We are slaves of returns. I would like to hold a stock for 10 years or for 100 years, for all my life, as Warren Buffett would say. But even the great man doesn't hold it for life.
Yeah.
If you see the level of activity. So it's nice to talk about a lot of things, but in the real world, we find that cycles have become much sharper, much shorter. And IT is a case in point. If you didn't have IT in 21, you were committing a sin. And if you have an IT in 22, you're committing a sin. How can you have such a dramatic thing? Similarly, what I feel is that if commodity is correct, the narrative of the market will change again because it is so intrinsic to most companies'
My only
profitability.
fear, Atul, with that argument is, and I'm being a devil's advocate here, is that if commodity will drop now, underlying commodity prices, they drop, the world would start crying about not inflation as a concern, but
Growth.
slowdown and growth and a recession around the corner.
Yeah.
And that's not great news for anybody.
So what I feel is that it's two parts. I feel that a lot of commodities are where they are is due to a lot of speculation. See, as equities as an asset class has been deteriorating, money moves across asset classes for a lot of fund managers. And I think there's a lot of speculation in commodities, and case in point is crude. Case in point is crude. I think it's a highly, highly speculative activity that is happening there. That is why this thing can fall $10 a day. Without any change in demand and supply dynamics. How does that happen? That is speculation. Somebody somewhere has got chopped off. So that kind of moves clearly tells me that there is a lot of speculation. Yes, commodity prices will come off more due to the speculation getting knocked off rather than a massive demand destruction. And yes, when there is talks of slowdown, suddenly the Fed narrative will change. Suddenly the Fed narrative changes and interest rates come into play. So as I said, every 2 months there is a new
So what
game.
is your positioning right now in the portfolio?
I personally am very, very bullish. Yes, we may have short-term falls. I remain very positive on autos. I remain very positive on capital goods. And I remain positive on select banks. May not be the heroes.
Not all the banks.
Not all the banks.
Private banks, PSU banks.
I prefer the PSU and more industrial-facing banks because I do think that they have really cleaned up their act. And the parameters of performances there have improved dramatically. So I feel that there is a lot more opportunity. So there is a sector shift. As I said, this sector shift leads to activity. But as I told you, the cycles have become shorter. Activity is imperative.
Is IT avoid?
I
Or
don't
IT
think
short?
so. No, not short at all.
There's nothing short
No,
in this
not at
market.
all. Because what happens is that when IT as a sector, see, there is a sentiment. When sentiment changes, the sharpest pullbacks will happen in IT because this is where the max oversold or massive pessimism
It
is.
amazes me. It just amazes me. For a sector where nobody wanted to sell, now nobody wants to buy.
Exactly. So, the market is changing so fast, whether it is more of machines coming into the game, which is creating these kind of moves, etc. That is again up for another discussion, another point in time. But the moves
You can
in
say
the
thank you
market,
to media, we are creating awareness.
yeah, why not? Why not? So there's a lot happening. There's a lot changing in the market.
Where are you picking up trends when we may use that classic market line, catch them young and watch them, see them grow? Where is that typical pattern?
So I am not in that category. I'm a trend investor, Nikunj. You know that for years. So I never have something new, undiscovered to say. I try to see what the market is telling me. Apart from the fundamentals, which have to be kosher and good, anything that is not backed by fundamentals ends badly. So that is the first prerequisite. But I am a trend investor, so I will not be able to share with you anything that's unknown or something that is undiscovered. I can tell you what the trend is. My strength is being able to realize that how long the trend will last.
When you look at Adani group of stocks, I'm not telling you to comment on them. Purely as a technical analyst, as a trend investor, the trend has been extraordinarily strong.
Yeah.
Trust me when I say that everybody is feeling left out.
Absolutely.
Nobody expected this kind of a rally.
Absolutely.
What should one do? Do these stocks qualify as a stock which you should now buy and buy aggressively on decline, or it's too late now?
See, what you rightly put it, if you look at the shareholding patterns of these stocks, you'll find that domestics have totally avoided it. But the way activity is happening, the way prices are moving, now we have reached that stage where people are going to capitulate or get into it out of sheer compulsion. As you said, the performance being one of them. I think that in the Adani group also, as I look at it, I am looking at two stocks. Again, which is, I would not name them, but obviously which is based on where I think there are fundamentals, there is genuine earnings and things like that. And you are also seeing that reflected in the price performance in the whole group. Because yes, the risk about having a single industry, which is very dependent on one family or whatever that there is, that if something goes wrong somewhere, the corrections tend to be very sharp. However, if you are in those stocks within the group also, which is backed by fundamentals and not pure story, the prices stop at some point in time. So pure storytelling, pure hope, pure something like that is something which I would always avoid. So within the group also, there are two of them which I think have good fundamentals.
The ones which are
behind.
present in the FNO.
Yeah, so they have good fundamentals. And yes, if something happens to the group, you are going to get whacked. But then that's a call you will have to make. That's a call you will have to make.
There are a lot of small sectors which are mushrooming up. You spoke about, I specifically remember, bearing stocks.
Yeah.
This was in July, June.
Yeah.
The three bearing stocks were at an all-time high.
Absolutely.
Today, if I look at defense stocks, all-time high.
Right.
Lot of soft capex of product companies are at an all-time high. Anything interesting in the so-called less than $10 billion market cap range?
I think this whole mobility, green, we don't have sectors for that. Yeah. See, first of all, the sectors that are available at the index levels, at the exchange levels are not very good representatives. You will have to narrow it down. So, like engineering per se, engineering that's related to automotive, towards autonomous driving, towards alternative energies. These are spaces that a lot of interesting things are happening. Ethanol plays, the kind of stocks we are talking about. But these are niche. And you go down and look at the numbers that they're delivering. It's fantastic. Plus the size of opportunity is massive. Like I was in Europe a few weeks ago. And I was surprised that the investors I spoke to, the fund managers I spoke to, the prerequisite before they started discussion is what is it for the environment?
ESG.
Yeah, ESG or whatever term that you think. They were so anything that's green. And investors are voting with their bucks. And I feel that there is a very big trend that's happening. Yes, the opportunity is there, but this side or this style of investing or these spaces are attracting also a lot of international money. Things that are going to be highly polluting or which have such issues will find it. Yes, they may find opportunistic buyers, they may find traders, but they are not going to find a lot of allocation. So I feel this whole green option, and engineering related to it is another thing. Just as we spoke of bearings, we spoke of some of the auto plays, we spoke of defense stocks. I think this also is a small niche, which is very interesting.
So I'll wrap it up with a couple of follow-up questions. What is your short-term market view? What is your medium-term market view? And what is your long-term market view?
Short-term market view is that we are part of a global correction due to the hawkishness of the Fed. I think that there may be, again, this can be a week. I don't know where it's going to stop, 16,800 on the Nifty or 16,500, I don't know. I mean, those are things which you get into semantics. I think that is the very short-term view. In the medium term, I see the market at 21,500, which I think would be more like a year kind of view. And if we are able to follow it up with earnings, and if the thesis that I've been talking about of India's secular move and the globe remains more or less okay, I think that we could just rip it apart. As Rakesh ji or Bhaiya would say, people say apna time aayega, apna time aa gaya hai. And all respect to his vision, to his thought process, to whatever. When somebody passes away, you actually tend to appreciate that a lot more. And I think I'm at that stage where I'm really able to appreciate his prediction, his style, his thought a lot more. Sadly, after he's gone.
What made him such a great trader?
I think that Nikunj, he had 3x. I always said he has 3 brains. He has 3x our brain power. He could be sitting with you, looking at the screen, which is a standard you and I have seen, trading, probably giving orders, yet talking about investments. So he could trade, a trader's mindset. He could be an investor's mindset. And yet he could get a phone call from a private equity investor and handle something. So he excelled in 3 areas. Rakesh's strength was his ability of each to play into other. Like, he proudly said he was a trader. Because he made his capital through trading. Yeah. How did he fund his investment? Through trading. He was a very successful investor. That's what people know about. But the fact is that the wealth that he has created in the last few years has been actually monetizing his PE plays. So in the secondary market, he didn't have any of those 100x kind of plays in the last few years. In fact, it was monetizing the PE plays which really gave him the 100x. So I think that Rakesh ji his thing was a 3x brain power, his ability to be in 3 different quadrants, do well, and then actually be able to amalgamize all those. And that, I think, is the reason for his wealth creation. And that is why, in our lifetime, even if we can do one of the 3, I think is phenomenal.
No, but specifically, we know Rakesh Jhunjhunwala, the great capital allocator, the great investor. I like to use the phrase, the man who literally saw tomorrow.
Absolutely,
right?
Absolutely.
What made him a great trader? You were associated with his firm. You've closely worked with him. Was he one of those disciplined traders who would go with the trend, respect stop losses, or trading for him was always this gut call based on human behavior?
No, I think you manage risk very well, Nikush. Okay. See, gut call and all, everyone has that. Some are right, some are wrong. He's also had his fair share of failures.
In trading. I'm talking about Rakesh Jhunjhunwala, the
trader. In trading. But the beauty was his risk management. Okay. So someone with his wealth, right, and his size, it is very easy to get arrogant that if I have a position that's going against me, khade rehte hain yaar. Like what happens to retail investors, that very often trading becomes delivery and becomes long term. Rakesh ji never let that happen. His ability to manage risk, I have seen him like exit losing positions, get back the next day, go through that immense amount of pain because he believed in risk management. And his trading was not that, yeah, he was good at it, but the way he managed risk. And the problem is that when you become very rich and you have a lot of liquidity, you can let that risk management go because you can afford it. He never let that happen till the last
Define moment. A trade which you would say is a classic trade which all traders should follow as an example. Where he got it wrong.
I think, well, let me tell you, put something where he got right very recently. So that would be a more good example. It is the case of Tata Steel, Tisco.
Okay.
You know, in 2000, we had this whole COVID and he could see the start of a commodity bull market. Whether it will be so big and all, nobody knew at that. So he got into Tata Steel, Tisco, at a very early stage and, you know, got in his initial quantity. It was more like a trade. It was more a study on international commodity prices, which we would share with him, which we would see charts on, etc. But as the trend progressed, he could see how the performance of Tisco as a company, he could understand the strengths. He went into, you know, the balance sheets, P&L, spoke to people, and you realize that how he actually doubled up his position. His ability to actually, as I call, that's a part of risk management. And as the trend continued to realize, he was convinced that this is not just a trade, it is not just a large trade, this is a trend. And he was able to take delivery or convert that into an investment. So a lot of Rakeshji's investments were not like that, you know, like Titan on day one he saw, oh my God, it's something great to happen. No, in those stages it was a company that was struggling, but it was his ability to pyramid. He built fantastic pyramids. And when he got convinced that this is a mega trend in the happening, he converted that into an investment.
I mean, frankly, if I think about it, there are a lot of stocks he's also got them wrong.
Absolutely.
But his ability to really withstand the pain. Yeah. A stock like Titan in his holding period of 25 years, I think must have fallen more than 50%, 3 or 4 times.
Yeah.
While the world was falling apart, he said, look, I'm going to stick to it. So his ability to buy and hold, I think, worked. So before we wrap, just one more famous anecdote of Rakesh Jhunjhunwala was that I would urge the Aam Admi not to trade. And I would say that why is that? Because you made your money through trading, so obviously trading is beneficial. He said, Daddy whiskey peete the, par hame mana karte the. Why is that we don't have too many successful traders? I mean, for those, the audience watching us, you are a successful trader. What do you think repetitively they are doing wrong?
I personally think that, you know, the discipline part of it.
Which is stop loss.
Yeah, which cannot be taught. We can see it on paper, I can tell you. But the fact is that when you get in, the emotional journey is such a roller coaster that most people cannot. The failure is not at the intellectual quotient. The failure is at the emotional quotient. The failure is not that you do not have money. The fact is that we fail to actually be able to follow the rules. And as I said, that just as the rules, I'm sure if he had 100 rupees in his pocket or he had 100 crores, the discipline with which he managed his positions was phenomenal. I mean, I used to wonder that, you know, someone like him could take losses. He had that ability, but the clinicalness or the ruthlessness with which he sold, in which he exited his positions, was fantastic. And that is what kept him afloat. That is why most successful traders will do well in a phase. But when the phase changes, all these rules go haywire and they are unable to recover and stand. He was able to do it for cycle after cycle for 30 years. And his risk management is something which kept him afloat.
You know, when you challenge the ordinary, you become extraordinary, and that is Rakesh Jhunjhunwala for you. He's told the worth how to convert 5,000 into his current wealth number, which is 40-50,000 crore.
Are ridiculous. The CAGR is ridiculous.
But yes, all I can say is that we all will miss him, but nobody will forget him.
I mean, the footprint is so massive. You know, when I see all the kind of people talk about him, you realize that there's so many facets to his personality. And, you know, it is so fascinating. I feel so privileged to have spent so much time with him. And as I said, that I'm realizing this more so after when he's gone. Because then you realize, oh my God, it was such a big footprint.
It was such a big footprint. I appreciate it. Right. Appreciate your time. So glad you
Thank
could
you.
join
Thanks-
us. Thank you
thanks
very
for
much.
having me.
That's
Thank
it on
you.
this edition of Market Makers. Thank you for tuning in.